Hello, everyone. Welcome to the Visionaries Show. My name is Jen Crow. I'm the branding lead of Authority Fusion, and here's my co-host.
Mohan and I run few companies and I'm interested in knowing more about companies.
Here with us today is Jeff Getty, a seasoned advisor with Callan Family Office.
Hello, Jeff. How are you?
Hi, I'm great. Thanks for having me on.
Nice to
Great.
have you here, Jeff.
Yeah, we're going to talk about Jeff's expertise. In fact, Jeff has been well versed in wealth management advisory functions for a long time. Now, I would like to kind of get our audience know about 6 areas. Number one is business ownership transition. I think you are very well versed in it. Another area will be business value optimization. The third, strategic exit options for businesses. That would be very much in your hand. Now, there is another area is negotiated unsolicited offers. That's another area you are really good at it. Now, how do we do next one? Increasing value of the businesses through proper due diligence. Then the last one I want to know, how do you optimize or minimize tax for businesses? So if you can cover these 6 areas in some details, that would be extremely valuable to our audience.
Great, let's do it.
The first area is like business ownership transition. That means somebody wants to sell it or exit. In what kind of steps you would? What are the processes? What will you do, and how do you prepare for it?
Yeah, so whenever you're starting off with the idea of I typically talk about a transition or a transaction. Transitions would be a change of ownership internally, so that would be a family member or another key management or employees, and a transaction would be to a sale to a third party. At the inception point, both of those processes kind of start in the same point, and then they diverge rather quickly because the concepts are kind of different, right? But they both kind of start at the same point where the owner has made the decision. It is time for whatever reason to move on. And that can be driven off a lot of different factors. One would be they just have, for lack of a better word, gotten up one day and decided time has come to move on to the next stage in life. That could be driven off of a health issue of themselves, a family member. It could be driven off of they're just ready to move on to something else. Or it just could be the point where they have, for example, I know we're going to get to this later, gotten a silly offer where the money's so good that it's time to cash out and move on. But there's some catalyst, there's some reason why they decide to do something. And the first step in that process is deciding, are we looking internally or externally? And really, a lot of that just comes down to looking at the situation, which is partially financial, and then partially what's in the best interest of all the stakeholders. The financial issue is relatively straightforward. Typically, financially, most owners are further ahead to sell to a third party. It's kind of difficult to get the same level of value out of a business if you're doing an internal transfer as if you're doing a third party sale. And usually when I talk to prospects or clients at the inception, I talk about a continuum. And if you think about a line, and at one far extreme of the line would be a liquidation, and the other extreme would be an IPO or initial public offering. The highest value for a business would be an IPO. The lowest value for a business would be a liquidation. And then there's different demarcation points along that line as to what relative value one would get for a business. Internal transitions would be closer to liquidation. So transfers to family members wouldn't be as low a value as a liquidation, but they would be closer to liquidation than they would be to IPO. And sales to third parties, to private equity, to strategic buyers would be closer to IPO. So if the decision at the outset is from a business owner, I need to or want to get the highest value possible, they're going to be leading towards typically sale to third party or IPO, right? So if it's just purely driven off of financials, that's kind of where they're going to start. They're going to be looking more towards third party. But usually typically decisions aren't based off of that. In my experience, that's not usually where people start. That's not the majority of the time. It usually starts with the stakeholder thought process, which is what is it that myself as the business owner is looking to get for the stakeholders, for myself, for my family members, and depending on how they feel about the community they reside in, the community stakeholders. What is it I want to take out of this deal? How important is it to me to have my, for example, children involved in the business, next generation? How important is it for me to have that business continue with the same name, the same management team? How important is that for me to have that business still reside and be a contributor inside the community? That tends to be a bigger issue in smaller communities, smaller towns where you're the primary employer than it is in much larger markets. But that's kind of where that process, that mindset first starts. And once we start getting to that initial stages of consideration or decision tree of, okay, I'm going to go down a particular path, then the owner starts to work through the processes to get to those next stages in that process. So for example, if we're going to get on the concept of an internal transition to family members, that's typically talking to a estate planning attorney to talk about gifting strategies or estate planning strategies to transition that business through a rigorous tax planning process. If it's to transition to internal employees or management, we might be talking about an ESOP, which would be talking to an ESOP firm, something like that. If it's a third party sale, we're typically, depending on the size of the business, talking about a business broker or an investment banker, things like that. So we typically start to talk about pulling together that team of advisors who's going to drive the process, so to speak, to get the best possible outcome for the owner. That's kind of how that process starts and how those we start setting up those milestones to effectuate the best transition or transaction process for the owner.
So now let me excellent. That's very, very good. Now let's say that I want to do the transition. What steps I should take? How do I plan it? And what are the key specific milestones before I start the process?
So for a transition, so it would a little bit depend on what type of transition. So if you're talking about, for example, transition to family members, that's slightly different than we're talking about transition to employees. But let's start with family members. So that would typically start with a hard look internally at who that transition is going to involve and who that transition is not going to involve. So for example, I am married and I'm a father of 3 children. In a circumstance like that, it would be highly unusual that all 3 of my children would have an equal ability to be involved at the same level in the business. It would also be impossible to have 3 CEOs to replace me if I were the CEO of the business. So it's an inward look to some extent to understand, again, this is a transition for family, who would be the likely heir apparent? Who would be the likely successor to take over as CEO? And then is there a role for all of the children in that transition, right? Is there a role for my other 2 kids? And if it's not just my kids, is it nieces and nephews? Is it folks like that? Like who else is going to be involved in that and what role can they play? And also, if there isn't a clear heir apparent to be the CEO, do I have to find a third-party CEO, a management team that can take it on? And what role do my kids actually play in that next generation of management and ownership? And bear in mind that ownership and management and employees don't necessarily all have to be the same hat. So you can have family members have an ownership stake, but don't have to be involved in day-to-day operations. And you can have family members that are involved in day-to-day operations that don't have to wear a strategic management hat. So oftentimes that decision tree is very difficult for, as a parent, to be objective about their relative strengths and weaknesses of their children. I mean, like I said, I'm a parent. It's sometimes hard to think about your kids that way. But in order to achieve the long-term success of that business, that's typically where you have to start, is look at your family members objectively and decide how can they actually do this? What roles can they play? And in my experience, that tends to be the hardest part because, quite frankly, the tax issues, the transition issues, the documentation issues, once you've kind of figured out who goes in what seat, those other parts and pieces and parts are relatively straightforward to do. And I say that with some experience. I've been a tax attorney for almost 30 years. I feel pretty comfortable saying, having sat in that seat for a long time, the actual documentation, the actual tax strategy work to pull that together is relatively straightforward with 30 years of experience. It's the other parts and parcels and pieces of the skill set to deal with the family issues that tends to be rather difficult.
Jeff, you've worked with different sizes of business, and between you and Mohan, you've seen this kind of succession planning happening in big enterprises, right? But before, in the early years of your career, I'm sure you've worked with smaller businesses. Now, thinking of succession planning is not only important for big enterprises. There are small to medium companies that are probably not thinking about it. They're not even aware that something like this must be done. Do you have stories from the past, which I know you're dealing with a lot of NDAs here, but if you can share some interesting stories that where this business didn't think about succession planning. And I want the audience to realize the importance of planning for this, planning for exit, no matter what size of business they're running.
Sure. I mean, if you work in this field for any length of time, you have a wealth of stories. You really do, good and bad, right? And I always tell people that every story is an experience, and you either have a success or you have a learning experience. And unfortunately, when you're younger and first starting out, I think you end up with more learning experiences than successes because you really don't know what you're taking on, and you don't necessarily understand the pitfalls that you're stepping into. Some of the ones that stick in my mind is pretty spectacular. I wouldn't say misses because again, they were learning experiences, is not asking the right questions. So a good example of that would be many years ago, I had a client who approached me. He had been to a ESOP seminar. And I have nothing against ESOPs. I've done plenty of ESOPs in my career. And for those who don't know, an ESOP is a fancy acronym for Employee Stock Ownership Plan. It is a very tax advantageous plan to transition ownership from typically one owner to a next generation of owners in a very tax advantageous manner. And it falls under ERISA. So it's a qualified plan. So it has a lot of rules attached to it. And I didn't ask the central question, which was, are you sure you want everyone in the management team and company to own a piece of the business, which is the crux of an ESOP plan, right? Everybody who's in the business more or less gets a piece of the business. Now, there's ways to adjust ownership so your management team kind of is in control, but everybody's going to end up with a piece of it. It was a very small business, so there weren't a ton of employees, but we got pretty far down this process. Now, in my defense, he had told me this is what he wanted. He had told me he had been to a seminar. He had already hired an ESOP firm to do the feasibility study, and he was already fairly far down this path before he talked to me. But we got pretty close to completion, and he then suddenly asked the question, well, at the end of the day, my son and son-in-law are going to have a majority stakeholder in this business, right? They're going to own 51% and control the business. And I said, well, not under this plan. It's going to be 100% ESOP company, and the ESOP's going to own it. Now, they'll have a big stakeholder in the ESOP, but no, the ESOP's going to be in control. There'll be trustees, and they'll be indirectly in control. And I kind of walk through how an ESOP works. And he said, time out, that's not what I want. So we had to do a reversal. We ended up doing a partial ESOP at about 30%. And we ended up with the son and son-in-law, between the two of them, owning about 60% of the business, a couple other people owning another piece. So we were able to pivot and make some changes. We still had a partial ESOP, got some nice tax benefits, and we were able to make some adjustments on the fly and make it work out. But I learned an important lesson that day, right? Which was, hey, when someone walks in your office door and says, I want this type of strategy, there's a couple of threshold questions you should really ask, which is, hey, for an ESOP, do you really want this? There's a couple of things, punch list items you should be asking before you go too far down that path. So that's a quick example of one of those situations where, hey, you should really ask certain questions before you go too far down the path. Because unfortunately, the owner thought they knew what they wanted, but they didn't fully develop in their mind what an ESOP actually meant, or at least 100% ESOP actually meant to them.
Yeah, let me ask you about the value, business value. You talk about business value optimization. What are the strategies to maximize the value, or is there a kind of a rule of thumb, or how do you determine what real value is?
Wow, that's a very interesting question. So when we talk about value, value means a couple different things. So, let's start with the definition of what we're talking about value. So value, for transition purposes typically is artificially low, right? Because that's me trying to transfer value to typically next generation. So like for my children, I would want the value to be depressed artificially low. So I think the value you're talking about is I'm going to sell my business to a third party. So I want that value to be as high as possible, correct? So how do we drive value? How do we make the value as high as possible? What's really interesting is a threshold issue around value. If you have a good tax advisor, which I'm assuming anyone listening to this or watching this, you have a good tax person. And if you have a good tax advisor, they've spent every year working on your taxes, trying to artificially deflate value for tax purposes. Because the goal of a good tax advisor is to show the least amount of profitability every year, so you pay the least amount of tax. That's businesses that have high value, have a high return, tend to pay high taxes. They have a high income, so they pay higher taxes. So a good tax advisor is depressing profitability, right? So it shows less profitability, so you pay less tax. So as a threshold issue, most businesses are designed on an annual ongoing basis to show the least amount of profitability possible. So just as a setting the stage, so to speak, when you are running your business day in and day out, you're probably showing your business in the worst light possible to go into a sales transaction, because you're showing profitability depressed, which shows value at its lowest mark. So just as a starting point, we usually have to start off with, hey, we need to do what's known as a recasting or restatement of your financials to take all the good tax planning that's been done over the years and undo it for reporting purposes, for financial statement purposes, and pull out all that planning and recast those financials to show the highest amount of profitability possible. So it shows the true value inherent in that business, right? So that's rule number one in order to show the highest level of value. So interestingly enough, just as a threshold issue, most business owners are quite surprised that if they're asked to share financials, the first thing we would tell them is don't until someone has the ability to come in and recast your financials, because they need to undo all that work that's been done first and foremost. That'll drive some value in and of itself, Mohan, as an outset issue.
Yeah, let me kind of give you my kind of thought. There are basically the valuation is on sometimes a multiplier of a top line revenue,
Yep.
or a multiplier of what we call EBITDA, earnings
Yes.
before income tax, depreciation, amortization. So EBITDA times some number, or top line some number, depending upon the where you are in the company and what status. Do you use those type of things, or and what would you kind of make some suggestions how one should approach to, if especially if you're exiting to sell it to a third party, or maybe even taking a company public? How will you value that?
So those are two markers that we would definitely look at, but in and of itself, those are not the definitive markers we would use. There's a lot of different ways to look at valuation. Those are two of them. But let's bear in mind at the end of the day, a business is worth what someone is willing to pay. In its simplest answer, right? We can play around with EBITDA, for example. We can make adjustments. We can make adjustments as to what real revenue is. We can make adjustments as to multiples. For those are just comparisons as to what other companies have sold for. Those are numbers that can be manipulated, and people do manipulate them. That's part of our jobs as M&A advisors, as a seller, as representing the seller, to make adjustments to those numbers and to put the best light possible. I tend to look at value in a sales process as much as anything is telling a story, which sounds overly simplistic, but just run with this for a second. There's always different methodologies one can use: discounted cash flow, multiples of EBITDA, top line revenue, the things we just talked about. But it's as much as anything else about telling a story. Most of the things we just talked about are looking in the past, right? Trailing indicators of what the business has done up to this point. To me, what the best indication of value is for a business is telling a story to a potential buyer of, yes, this is what the business has done historically, but what I'm going to tell you about, potential buyer, is what the business can do in the future with you, buyer, at the helm, which really comes down to if you, buyer, can do more with the business. So as an example, I'm the seller. I never wanted to take my business across state lines for whatever reason. I was happy. I'm a resident of Pennsylvania, so I stayed in Pennsylvania because I never wanted to do sales tax across state lines. But you, Mohan, you're in California, and you could buy my business and you could open up a branch or merge it with your businesses in California, Nevada, and places out west, and you could sell my products and goods and services out there and, really ramp up that business. If I can convince you just by buying me, right, my business, and you could sell more goods and products from my business line out in those markets, I'm giving you a story that shows an increase in value beyond what I could get out of that business. So therefore, it's worth more to you. That's storytelling, right?
How'd you know that? How do you know let's say you're helping a buyer, a seller, a
Well,
business?
that's where a good,
How do you know their intent? Because you're working with this one other party. What about
yeah,
the other party?
great question, Jen. So one of the jobs of an M&A advisor in this part of the seller's M&A advisor, is to understand the buyers in the mix and do research on them, and to be able to talk to them and articulate to each different buyer what they're doing. So when I've been involved in sales processes and we get down to the point where we're talking to specific buyers, the internet's a great thing. You can do a ton of research on them. If they're a private equity group or a strategic buyer, you can look at their strategy. You can look at past acquisitions. You can look at what they're doing right now, and you can fill in those gaps, and you can figure out exactly what it is what their strategy is, and then you can kind of figure out what it is they're trying to do. You can ask them what it is they're trying to do to some extent, and you can position that sales process, that thought process, to align with what they're doing. And then you can kind of back into the financial metrics. And there's actually software that can help you, if you know how to use it, build out a model to show what, if you make some assumptions, what that valuation would be worth on their platform. So you can actually go in and say, hey, based on what we know about your business, Mohan, we believe on Mohan's platform of his business, this business is not worth X, it's worth X times 2 or X times 3. So that's part of that negotiation process, is to show them what that's worth.
But before you really, you're going to make a sale or whatever, would you recommend get a professional appraiser to go through the valuation process and get some range of values such that you have an objective internal kind of a measure such that when you talk to a buyer, then you can present that, or you don't recommend that?
So I do typically, but understand it's a very specific type of valuation. It's not an appraisal, because appraisal to me is like for gift and estate tax purposes, which has absolutely no bearing in an M&A process. We typically, when we work with an investment banker, they will give us their the range of value of valuation that they believe the business would sell for. It's a nice demarcation point, so we know ballpark what that business should sell for, so we know kind of what we're looking at. But we don't share it with the marketplace. That's just for our information only. So we know basically what we're looking at. It also gives us some idea strategically if we're going to do any tax planning, which I know we'll get to in a few minutes, what kind of numbers we're playing with. But it's just kind of for our information. It really has no bearing, in my opinion, in the sales process itself, because again, depending on where the markets sit, and when I say the markets, the M&A markets, that number could be wildly off. I mean, we've had a lot of circumstances over the years where we see, for example, a very wide range where the valuation comes in and the investment banker says, hey, this will sell between 30 and 50 million. That's an enormous range. And it sells for 60 because there is a strategic out there that says, I just need to have this business. And it shocks all of us. And we've seen other circumstances where we think the business is going to go for a lot more. And then something, and I know we're going to get to this as well, something pops up in due diligence that really pushes that value down, which was kind of a surprise on the other and a kind of a bad surprise. So nice to have, but in and of itself is not determinative. It's kind of one of those back pocket things that gives us a ballpark to work off of. And that's all I would view it as, is a ballpark for us internally to work off of.
Okay, now let me ask you to kind of go over, when you talk about strategic exit option, what are the
Yeah.
strategic exit options that are available?
Yeah, so it depends how you slice and dice things, but the strategic exit options I typically talk about, and I'll work from the kind of the bottom lowest value of the list to the highest. I mentioned before a liquidation, which isn't really a strategic exit option. That's the worst case scenario where the business really has no value except liquidation of assets. But with the lowest one would be, hey, I really just want to give this or gift this to my kids, my family, right? Nothing wrong with it. That's a strategic option. We go through that analysis. Is this an option you want to pursue, you want to consider? Then the next one on the list would be a part gift, part sale. And this would typically be for an owner who wants to get it to next generation or to family members, but also needs some level of money out of the sale or out of the process to live off of, right? So the first one would be, look, I have enough money outside the business. I can just give the business to family members. I don't need anything. I can just give it to them. The second one would be, hey, I need to actually take some value out to retire on, to live off of. The third one would be typically an ESOP. That tends to go as far, I'm doing this based on what I think valuation would typically come in at. So that would be an ESOP, which is the employee stock option plan. Then I would typically see a management buyout, which would be, again, ESOP would be selling to the entire company. A management buyout would be just selling to the management team. The one after that would typically be a financial buyer, which would be a private equity firm. And after that would be a private equity firm on a strategic platform. And that line is getting very blurred these days. I think most private equity firms are really that other option with a strategic platform. Then a pure strategic buyer. And then the one beyond that is a IPO. And to put some math around that, if we said a pure private equity buyer would pay $100 for that business, right? A strategic would pay about $120 for the business. An IPO would pay you about $140. Going downstream, a management buyout would pay you about $85. An ESOP would pay you about $75. A part sale, part gift would be about $65, and then a gift would be about $50. That's kind of how I put that math in my head, and I kind of explain that to clients. If you're thinking about relative value between those, that's kind of how the math in my experience, has worked out for valuation for clients. That's kind of how that math comes together.
That's excellent. That's exactly right. I totally agree with you. That's the various types of transition would bring the value to the seller. In addition to that, there are certain, of course, we'll come to that, tax implications when you do, instead of getting a cash, if you're going to get some equity into other buying institution, you can delay the tax payments, or you can kind of some or other minimize the tax ramification in some way. We can talk about it a little bit later, but that's a very good summary of how do you do the strategic transition. Jen, you have anything? And I have
Yeah,
three more items to talk about. Yeah.
well, just we're halfway through, so I want to talk about Jeff being an author as well. So if you can tell us a little bit more about the book you've written. The title is "The Descent is the Real Climb." I'm very curious. Why the title?
Yeah. So the title came about because many years ago I was watching a National Geographic special. So there's my plug for Nat Geo, which is something I enjoy watching, and it was a debate on who made it to the top of Mount Everest first. And there's probably a lot of people out there who would say, I don't care. But I happen to be a little bit entranced by this thought process. And the debate was who made it to the top first, George Mallory or Sir Edmund Hillary. And to a certain extent, I didn't care because my thing was, well, it matters for historical preference, but really, to some extent, it doesn't matter because what really was important is who made it to the top first matters less as to who made it to the top and successfully made it down, which is clearly Sir Edmund Hillary, right? George Mallory, there's pretty good evidence that he made it to the top about 30 years before Sir Edmund Hillary made it, but he didn't successfully descend down. And so I watched this special, and they went through this whole analysis. And again, it was pretty evident to me that probably George Mallory made it up first, but he didn't successfully get down. And then I was thinking about how many business owners I've talked to over the years and have seen that ran a very successful business, right? And just really, really knocked the ball out of the park, were very good at what they did, but they were never able to successfully transition or transact that business. They could never get it to next generation. They could never monetize it, right? And they literally ended up having to sell it for pennies on the dollar, or their family did, or they just had to work the rest of their life because they ended up with a lifestyle business. And I thought, when I started to work on that book, that this would be a great title to kind of think about, the ability, because so many owners are able to successfully get to the top, right? Like George Mallory, but they can't get down. But you get the fewer ones that get up to the top and then successfully descend. So that's the genesis behind the title. It's a feat to get to the top, no doubt. But it's even a bigger feat to get to the top and then be able to come back down. And that's why we celebrate Sir Edmund Hillary, and why most people, unless you're a strange one like me, really don't know who George Mallory was.
Well, that's very smart.
Very, very interesting.
Have you encountered any business at all, even a business that you didn't have to handle yourself, that actually just, they just shut down, but with the potential of making some money out of it?
I mean, sure. I've seen plenty of businesses not make it. I mean, there's a statistic that floats around. I've never actually seen attribution as to what this study is based on, but it's conventional wisdom that about 60% of businesses, closely held businesses, make it from first to second generation. But this is not third-party sales. This is internal transitions. And only about 11% make it to the third generation. Oh. And I believe that stat to be more or less true because it's just you don't see a lot of businesses making it that many generations. People's mindsets change. I don't think people are super good at training or teaching successive generations how to manage businesses. Ownership gets diluted. There's a whole bunch of things that happen, and there's family dynamics. People are poor at dealing with family dynamics, which is probably the largest single issue. When you really dissect, and I have looked at studies on this, what makes businesses fail between generations has very little to do with tax planning. That's not typically the issue. It's the issue, it's everything but that, right? It's really all the other pieces and parts. It's
Yep.
keeping too much control at the senior generation. It's not bringing people along. I could go on because I've seen it. It's all the challenges we deal with. Like I said, the tax parts, once we figure out what it is we want to do, pulling together the tax strategy to accomplish it's relatively straightforward.
Yeah, before I let Mohan proceed to the last 3 points, I just want to say this is why you need to get out there more, Jeff, because there's just one restaurant here that people loved, owned by at least 2, 3 generations, and they just shut down.
Yeah.
And we asked, because it's a small community here, we asked around, so what happened? Oh, we just retired. No one would take over. That's it. And we love their German cake.
Yeah. It's,
So anyway, Mohan, you may proceed with with going through your last 3 points.
Last 3 points. Maybe you may want to explain or enlarge what is this unsolicited, negotiating this unsolicited offer.
yeah. So it's kind of funny. The concept of an unsolicited offer is relatively new in my experience. I mean, years ago, and I'm talking when I first got in this business back in the mid 90s, an unsolicited offer was, at least in my experience, fairly rare. It didn't, because it just didn't happen, right? Most businesses in those days, at least in the lower middle market, transitioned either to family members or what I would consider a very orderly fashion. Someone decided they were going to exit and they would decide I'm either going to, like I said, transition it to family members or they were going to sell. And they picked up the phone and hired an investment banker or a business broker and went through a process and did that whole process, which if you want me to, I'll talk about what that looks like. And that's the way things went. And then something happened in the late 90s. We saw a growth in the development of private equity firms, which really took off. And personally, I think that's been a good thing. So I don't think private equity is a bad thing. I deal with a lot of private equity groups. They get a bad rap. But that growth of private equity has brought about what I call a little bit, and people might say this disparagingly, and I don't mean it that way, what I call the dialing for dollars, where you have people who work inside of private equity firms that are charged with, and they're typically more on the junior side, who know the types of businesses the firm is looking to acquire, and they call up potential acquisitions and try to get the owner on the phone and try to start talking to them and then try to make an offer to purchase the business for a price. And that's the crux of the unsolicited offer. So it's a little more complex than that. But what happens is the owner is not anticipating selling, or maybe it's in the back of their mind, and they get into a conversation with somebody, typically from a private equity group. And during the course of that conversation, numbers get out, right? Where the person from the private equity group gets some information from them. They find out basically what the business is doing. Typically, they get some level of financials. And then the private equity group does some sort of analysis and then comes back with a number. And typically that number is something that surprises them a little bit because they've always run the business a certain way. And they typically never really thought about either what it is they would need to take out of a deal to sell it. Mm-hmm. And they never really thought about what the business might be worth to someone else. So as I describe it, suddenly they're in the middle of a sales process without realizing they were even in a sales process. And then they're negotiating a deal. And that's the crux of the unsolicited offer. And the challenge factor that I see it is they end up negotiating kind of against themselves. So they've already given over financial information without any adjustments. They've never really thought about what it is they need out of a deal. They've never gone through the impact that it might have to themselves, the other stakeholders, family members, things like that. They've never done a strategic option analysis. Is a third-party sale really the right choice? So they've kind of skipped a lot of really important steps. And unfortunately, they're kind of pretty far down a path with a pretty aggressive potential buyer, right? And there's, it's kind of hard to undo that. So it creates a challenge. And today, I'd say almost 50% of the deals that we see start with an unsolicited offer. Now, not all of them are quite that far. Some of the deals we get or some of the things we see are, hey, the phone rings, hey, Jeff, we started a conversation and this private equity group wants us to send over financials. What do you think? But that's an unsolicited offer. It just didn't get very far. So that's okay. That's a little bit easier to deal with. Some of them are, hey, they put a letter of intent in front of us or a sale agreement. What do you think? That's a lot further along. That's a lot harder to kind of undo or to get our arms around. But about 50%, maybe slightly over, that's when we get the first phone call. They're already kind of down a path of an unsolicited offer, and it makes things a little tougher. It leads to more deal flow, but it definitely makes things a little more challenging as an advisor to try to get the best outcome possible for clients.
Would you sometimes see unsolicited offer from a strategic customer?
Sure, very frequently. That usually comes up in a slightly different context. Again, oversimplification, but where I see those come up a lot, it comes up at the proverbial industry conference where the strategic and the potential acquiree will be at an industry conference. I always envision this over a drink at the end of the day where they're talking and the strategic buyer is having a drink with them and they say, oh, if you're ever thinking about selling, we'd love to buy your business. And the person's tired at the end of the day and says, well, sure, I'm always in the mood for a potential offer, let's talk. And then they're off to the races. And that has actually transpired with clients that I know more frequently than people think, because again, strategic buyers, my personal experience in most industries, what's going on, they are trying to grow. Organic growth continues to be challenging for a lot of businesses. So if you can't grow organically, you grow by acquisition. No different than a lot of big publicly traded companies do. And some of these strategic purchases are by big publicly traded companies, and they're looking to grow. So they grow by acquisitions. They do it that way. So that's how a lot of those deals happen. It's just what starts off as what looks like a casual conversation. I don't think oftentimes it is a casual conversation. It's very targeted, very methodical, but that's where they start, and they start there and they finish soon thereafter because they throw out a decent sized number and then it's off to the races.
Yeah, generally my experience is if there is a strategic buyer, you get a better valuation.
That's, historically, I'd say that's right 90 some percent of the time. The line between the higher value of strategic versus private equity, it's kind of lessened a little bit, but I agree generally strategics are higher. Yeah. And they tend to be, I wouldn't say always easier to deal with, but there's a lot more pure, in my experience, a lot more pure cash deals than with the private equity groups. Again, not always, but you're more likely to see a pure cash deal, less carry forward, things like that.
I don't care who answers to this, but why is the valuation higher again in that situation?
Because it's more valuable to them. The buyer thinks it's not like organic growth. They can make 2 + 2 5.
Yeah.
So they are willing to share the value.
They can make their return on their investment much faster, much faster. It just, they can make up their differential sometimes almost immediately. The 2 + 2 = 5 is a great example. The private equity groups typically take some time to get their investment back. The strategics oftentimes can make it back almost overnight. So they're willing to pay more because they can make that back very quickly.
Exactly. Now, changing the next area, you said, or you kind of recommend increasing value through due diligence preparation in some fashion. Kind of
Yep.
walk me through what needs to be done and what is the steps one has to go through.
Yeah. So let's talk a little bit about how due diligence works, because I think it's really important for people to understand. So when you go into a sales process, there's the initial negotiation that gets you to a letter of intent, which is really a agreement to move forward into a sales process. So it's usually gets you to an exclusive negotiation where, again, I'll use the example, Mohan, you're going to buy my business. We reduce that to a writing. We agree upon a preliminary price. And really what that is, it says, I'm not going to accept any more offers. I'm not going to negotiate with anybody else. And I'm going to allow you to really dig into my business before you close. And that starts what's known as the due diligence process, which lasts, depending on the industry and the complexity of the business, typically anywhere from 60 to like 120 days, where I allow Mohan and his folks, his teammates, to come in and look at my company, dig through my books, walk the factory line, probably talk to my employees, talk to my management team, really try to find the skeletons in the closet, try to figure out what's inside the business that wasn't obvious when he was negotiating the purchase price.
So like
And
you will have a data room set for them so they
yeah,
can go and examine everything they want to know. But you would create some kind of an NDA prior to them coming and do the whole due diligence, correct?
yeah. In a very imperfect analogy, I'd say selling a business is kind of like selling a house, right? People walk through, they take a look, somebody makes an offer, you go back and forth, you agree upon a price, and then you bring in someone to do an inspection, right? And they're going to dig around and find the stuff a typical buyer wouldn't see just walking through. It's not perfect, but it's similar enough, right?
Right.
And at the end of that due diligence process, then Mohan's team goes back to him and says, here's the list of stuff we found. And then Mohan shares that with me and says, okay, because of these things I found, here's what I'm changing my offer to, right? So he has the ability based on what he found to, I guess technically he could increase the offer. I've never actually seen that, or reduce the offer, right? So what Mohan's question was about is what can one do as a seller? So again, going back to me, what could I do as a seller before I negotiate in the sales process with Mohan, before a letter of intent, to be prepared for due diligence so I don't get a negotiated reduction, right? So we call that a pre-due diligence process. I've heard it called different things. But what we do is we work with clients long before the company goes up on the market, right? So this is well before there's any sort of sales process. And we are hired to
It's
come in and
like
pretend
it's
we're a buyer.
like it's like if you're going to sell a house, you get a contractor first and come and say, do the review it, see where things are, and let's fix it, and everything is in place, and then you initiate that. So there is some similarity to that, correct?
Yeah,
Yeah.
more like staging the house, getting
Well,
it
it's
ready
it's
for.
part staging. That's a good analogy. But also, I talk about a concept called cognitive dissonance, which I love fancy words once in a while. But I use the example of years ago, my wife and I were selling a house, and there was a cabinet door in our kitchen there was a hinge that was broken. And I knew it was broken. My wife knew it was broken. But we got to a point where we both didn't see it anymore. And right before we listed the house, a realtor came through and said, you have to fix the hinge on that door because any buyer is going to walk in and they're going to see that. And then they're going to wonder what else is broken in this house you haven't fixed. And it wasn't like we didn't know it was broken, we just didn't see it anymore. And that's cognitive dissonance. So to a certain extent, the pre-due diligence process is to have someone come in and see the obvious stuff. It's not just the stuff you don't know about, right? Which would be the contractor. It's the stuff you do know about, you just don't see, right? So it is staging, it's doing a deep dive, it's to try to find everything they could possibly see to either figure out, is it something we identify and is worth fixing, or it's something we just want to disclose and put a good face on it. And here's why there's a difference between the two. If we find something in pre-due diligence that's going to cost us $50,000 to fix, but is going to increase the sales price by $5 million, that's something we're going to fix, right? If it's something that's going to cost us $5 million to fix, but is only going to put $50,000 in purchase price or sales price, we're not going to fix that. But what we will do is we'll disclose it during the sales process so we don't pay for it in due diligence. So sometimes it's just about telling the right story about the issue. So we might say during the negotiations, hey, Mohan, we have this issue inside the business. We want you to know about it before you make the offer, right? But here's why it's not that big of an issue. So what does that do? Well, it prevents Mohan from coming back in due diligence and saying, you never told me about this, so therefore I'm going to reduce my purchase price after due diligence. So there's a little bit of art form what you do with the pre-due diligence information. Sometimes you fix it, sometimes you just disclose it, and sometimes you try to do something in between, which is to put lipstick on it, right? It's a little bit of an art form there, how you deal with it, but it all comes down to, it's a trying to put value or trying to at least make sure you're not reducing value by what's in the skeleton in the closet, so to speak.
This art you're talking about is another book of yours.
Yeah.
Telling you, it's not straightforward. You talked a lot about a lot of things you do that's not as straightforward as it's just getting the multiplier of EBITDA or revenue. It's just great.
I tell people that there's something to be said about experience and some gray hair. And I think there is, as much as I hated to hear that when I was in my 20s and starting out, there's something to be said for it. You do learn a lot over the years and along the way. And unfortunately or fortunately for me at this point, experience counts in this business. You get to see a lot, you learn a lot, right? And there's only so much you can take from textbooks and things like that. You just learn a lot by just doing. And I've never kept track of how many transactions and transitions I've worked on. It hundreds and hundreds and hundreds. I don't even know. And again, I've learned more from the ones that didn't go smoothly than the ones that did go smoothly. And by the way, very few have gone completely smoothly. Almost all of them have had some hiccup.
That's why I always recommend or advise, if they are thinking of selling a business, before you do anything, get a strategic advisor so that that person can kind of go through the overall strategies and with their experience of doing, you can actually add significant value to the business. So
I think
that's
that's
the process one should take. In fact, everybody, like I've done some exit, a fairly big exit. We have strategic advisor coming and doing all the preparatory work, and obviously that has increased the value. That's everybody should do that, no question about it. Anyway, last subject I want to bring up. It's a very generic tax optimization for a business. Well, how would you attack, or what type of things, or what are the minimum things people should do to maximize the benefit?
Yeah. So now we're actually talking about the subject that I like the best.
Best is always the last.
Yeah. So I technically I started my career as a tax attorney. So I have a law degree and a master's degree in tax, and thought I would spend my entire career as a tax attorney. And I guess technically I still am, but I've branched out a little bit. I love taxes. I live and breathe them, and this is my favorite part of the conversation. So I love saving it for last.
Having it for that, yes.
Yeah. So let's start off with how I view taxes, right? And then we'll get into some details. But we talk about what we call the tax trilogy. And that's the easiest way to start this off so I can paint a very good picture for people. Most tax mindsets start and stop with a viewpoint of, hey, this is what you're going to owe on your transaction, right? Like, I'm going to sell my business, and they go to their accountant or their tax advisor, and they look at it and they say, okay, if you sell for X, you owe Y in taxes. And if they have a good estate planner, they will tell them you should transfer 10% of the business to a trust for your kids' benefit before you sell. And that's where things start and stop. And I say that, and it sounds really critical, but this is what I see the vast majority of the time. That's just what I see. And for me, that's a shame because I really truly believe taxes in a transaction are, at least in large part, very discretionary how much you pay. So, what is the tax trilogy? Well, it's viewing taxes, three distinct taxes over three distinct time frames. So, let's talk about the taxes you're faced with. Number one is the federal income or capital gains tax. Number two is state income taxes. And number three is the federal and, I guess, state transfer tax system. So, estate taxes, inheritance taxes, things like that. Over the distinct time frames, you have pre-sale tax planning, you have during the transaction tax planning, and then you have post-transaction or transition tax planning. If you're not looking at three different types of taxes over those three distinct time frames, I can guarantee you're leaving something on the table. Just hands down, if you're not looking at it from that approach, you're leaving something on the table. And by the way, to put some metrics around this, here's what you're looking at as far as rates go. The federal, at least 20%. The state, depends where you live, it's as low as zero if you happen to live in Texas or Florida. Mohan, you're California, so I know you got to be in double digits. Yeah. And then, federal transfer taxes, they bounce a little bit, but they're about 40% now. And for inheritance taxes, they run sometimes as high as 10 or 15%, right? So these are big numbers. These really eat into, profitability on a sale process. So I could talk for taxes about hours. Let's hit a couple of different high points. Tax strategy work really should start long before you're even thinking about going into market for transaction. If you are thinking, I might want to do something in 3 years, now's the time to start thinking about taxes. Because as you're thinking about strategic options, your tax strategy will be somewhat dictated about what you're doing. And what in the world do I mean by that? Well, if you're going to sell to a third party, your tax strategy is going to look materially different than if you're going to give the business to your kids. It's just going to be a very different mindset. It's going to be a very different toolkit. Now, having said that, I don't always run into clients who are 100% certain what they're going to do. So there are some things you can do that would work to some extent for either strategy. And then as you get closer in time to an action point of which path you're going down, then you can pull the trigger doing different things. But suffice it to say, usually about a year before someone goes down before they pull the trigger one way or the other, they should know which path they're going down. But they should at least be thinking about it 2 or 3 years in advance. Okay, I just need to start thinking about how is my business owned? How is it structured? Is everything held in one entity? And why is it held in one entity? Right? Does it make sense to spin off the real estate from the operating business if that's an option? Does it make sense that I'm an LLC versus something else, or a C Corp versus an S Corp? And by the way, as an owner, you might not know why you're one of these entities, but you should be asking that question, why you're one of those entities. I usually start with potential clients with, okay, you shared with me the information on your corporate structure and your ownership stack and everything else. I don't usually ask them why it's this way. I just look at it and start digging into it, and then get on the phone with their corporate attorney and say, okay, why is it this way? I don't expect the client to know that. I want to talk to their advisors as to why it's that way, and start thinking about ways to restack things, right? So we start devolving into different tax strategies. Then we start looking at what movement parts, like what are the long-term goals and objectives of the client? Is it really everything is about they want to put as much money in their pocket, or do they want to enrich some family members at the same time? And there's no judgment call here. I could care less what their goals and objectives are. I just need to know what they are. Are they interested in benefiting a charity or not? Like, what is it short-term, medium-term, long-term? Then as we get closer in time to, let's stick with transaction for a second, what is the likely structure of a transaction? Is it an S Corp? And if it's an S Corp, is it likely to be sold to a private equity group? Because if it is, that typically dictates a very specific type of structure. That's typically, and I don't want to go down a deep dive here, but that's typically to be a subchapter F reorg, which has a very specific type of tax treatment, which leads to a very specific type of tax planning we would do. If it's a C corp, we go down an entirely different path, right? So like there's certain things we would do and not do. Is it likely to be an asset sale versus a stock sale? Because again, as we start getting closer in time to the transaction, it starts to dictate which mindset, which strategies we're going to deploy, what's on the menu, what's on the table. Then when we actually get into closer to a deal, so that's all pre-sale planning. So we pull together these structures and strategies up to the point in time when we go to market. Then when we're at market and we start to really crystallize what this deal is going to look like, here's the actual math, here's the actual numbers. Then we start getting into things like potential purchase price allocation, different types of deal structures, carry forward in the deal, things like that, different things that we're going to be able to do from a tax planning perspective to make certain elections, to help advise the investment banker in their negotiations, right? Because there's going to be different answers when the buyer comes back and says, hey, we want to structure the deal this way. The investment banker might not care because it's not material to them. It could be an enormous difference from a tax perspective. And by the way, an investment banker shouldn't know the difference and probably wouldn't care, right? They're not going to advise you on that. And then the last piece would be once the deal closes, the post-sale work, 2 points. One is from that point in time to the end of the year, you have cleanup for that year's tax return. And then you have after that year, the subsequent tax planning, right? All the things you're going to do after that. These are how one must dissect these things. Now, my goal is when I sit down with a client is the average tax rate nationwide, in my experience. Again, I've done deals in 43 states, so I think I've got a pretty good handle what the average tax rate would look like over my career, is about 30%. Now, tax rates ebb and flow in different states and everything, but my experience is about, if there's no tax planning, people tend to pay around 30%. I like simple math, so let's just say that's about a third. So about a third of your sales price will go to taxes, whether it's state, local, federal, that's where it goes. If we have some time, like don't call me the day before you sell, the day before the transaction closes, we have a little bit of time, we can typically get that number under 20% without too much pain and torture. So about a third of the tax rate we can shave off without a lot of trouble. If you give me a little more time and you want to get a little more creative and you're willing to wait for some of that money, right? We just want to create some strategies, some structures and things like that. We can get it under 20, we can get it to around 15. And if you really want to create it creative, we can get underneath that. So it's really a question of how creative you want to be and how much time you want to spend. We can really whittle away at the tax rate. It really depends on some factors, but again, it's just how much leash and how much time are you willing to give someone like myself, whether it's me or some other tax advisor is really good at this space. If they're good, they should be able to help you with this. There's a lot of tools in the toolkit. And I know that I was asked before to talk a little about QSBS, and I'm happy to get into that. But before I do, is there anything I didn't talk about, Mohan or Jen, before I talk about QSBS for a moment?
No, that's very good. That's the
Sure.
one I wanted to ask you was 1202, which is, gives a lot of small business. Of course, big business, they don't benefit. But many of the people, I don't know, everybody takes advantage of that, whether people don't know. And that would be a good thing to at least highlight how that could be used or when they should start thinking, and in fact, how really attractive that is. Maybe you may want to shed some light on that.
Yeah, so if you've never heard of 1202, don't feel bad. 1202 has been around since 1993, but it really didn't start becoming a big thing until 2017 with that Tax Act, when the corporate tax rate dropped pretty substantially. 1202 was created to encourage investment in small businesses in the United States. It has a very strict set of parameters around it. So Section 1202 is also known as QSBS, Qualified Small Business Stock. The qualification requirements are it is a C corporation, a domestic C corporation, I should start with that. That is not an excluded business, which would typically be like service businesses, so no law firms, RIAs, things like that. And the asset value of the business, not valuation, the asset value of the business has to be under $50 million when it's initially qualified. There's a few other requirements, but let's just run with that for a second. And if you were an investor or you started that business and it qualified at the time you invested in it, you can exclude up to $10 million in gain per the greater of $10 million in gain per taxpayer, or 10 times your basis in the investment when you sell that interest in the business. So it's a two-part test. So the easy way to describe it would be an example. If I invested in a business, let's say, and you have to hold it for 5 years. So the reason why it's become bigger, 2017, the tax law changed, it became much more attractive. 5 years from 2017, 2022, we saw a big uptick in 1202, and it's even increasing more. There's a lot of PE groups that invest only in Section 1202 companies, so we see a lot of PE investments are now starting to qualify for 1202. For what it's worth, about 50%, 60% of my time is with PE funds right now, structuring helping them with their exits from 1202 and their investors. But anyway, I digress. So let's use my example. I invested in a company that qualified, and the business was sold, and my personal gain was $10 million. That following year, when it comes time to file my taxes, I mark that on my return. My accountant technically would mark it on my return as it qualified for 1202. And even though there was a $10 million gain, I pay zero tax on that gain.
But do you have to pay the state tax, don't you?
It's not an estate tax savings. This is purely an income tax savings. That's correct.
Only federal tax.
Well, actually, interestingly enough, 45 states follow the federal rules. So in 45 states, you get the exact same treatment. In the 5 states that don't follow the federal rules, you typically, and I say typically because it's not necessarily a slam dunk, you can move that interest into a trust in a jurisdiction that does follow the QSBS rules, and you can avoid your home state taxation. So you typically can have QSBS qualify for state income taxes as well if you know what you're doing. So QSBS can be a complete elimination of both state and federal tax if you know what you're doing. You also have the ability to create multiple taxpayers for QSBS purposes. So it's not uncommon that people who invest in QSBS and that investment really takes off, that they will do some transferring of their interest. We've had some success with owners and investors who have, for example, again, I'm married, so I can do this, they'll take their ownership interest and they'll say, okay, I'm going to move part of the ownership interest to my wife. That's another $10 million. And oh, by the way, I have, like I said, 3 kids. I could create trusts for each of my kids. That's another 3 taxpayers. So now I'm at 50 million in exclusion. And then I could probably create another trust for my entire family. That's 6. So I could exclude $60 million in gain pretty easily without any trouble, without any big conflict from the IRS. So this, in my opinion, is one of the most powerful provisions available in the Internal Revenue Code today, and isn't particularly controversial, unlike a lot of other tax strategies that tend to have a lot of, I want to say issues around it, but questions like how far can you push this, and is it really available? This is clearly in the code. This is one of those things that, as of the law stands today, is so straightforward, and it's shocking to me how few people take advantage of it. There are ways that it can be disqualified, but it's actually kind of hard to disqualify, but most people don't understand these rules particularly well, and it's really a shame. We run into a lot of clients who over the years haven't taken advantage of it because they just didn't know how it worked. A lot of tax advisors don't know how it works.
Especially the tax preparing people don't know that. That is
Yeah,
the lengthy part of it.
Mm.
Yes.
yeah, it's really common. So we actually, myself and one of my colleagues, we run what we call a master's class, particularly for PE and VC funds, and we do this for all over the country. Because, like I said, a lot of VC and PE funds specifically structure their funds to invest in QSBS companies, and we come into their shareholder meetings and we do an hour long class on QSBS and how it works. And I'm shocked because almost every investor knows QSBS exists, but very few of them know how to take advantage of it. They know it exists, they know what the general rules are, but they've never had the opportunity to take advantage of it. So they're quite appreciative of the fact that, oh, this works. So it's a really powerful provision. I could talk for at least an hour on QSBS, but hopefully you get the basic flavor of it. And if you invested in a C corporation or you're invested in private equity or VC or venture capital, you should ask the question, does this
Exactly.
qualify for QSBS or does it look like it qualifies for QSBS? And if it
Let
does,
me interject here and say, our viewers, whoever watching, if there is anybody who wants to know more about it, I mean, they can certainly reach us. But is it okay if they reach you and say that maybe you need to advise us or something? So we should make that available to our viewers because there is a tremendous opportunity for
Yeah.
people to take advantage of that provision, which is some or other many don't really take advantage of it. I don't know why, but mostly they don't know. So this could be an opportunity we should extend, and they can call us as well as Jeff.
I'm happy to take those phone calls. They're more than welcome to reach out to me. I'm happy to talk with them and tell them how this all works. Yeah, that's fine. I'm more than happy to reach out, and I'm more than happy to do what I've done in the past, which is if it's a fund or come in and talk to a group. To me, it's an education issue, and education usually leads at some point to opportunity for me. So I'm happy to do it. I do these all over the country.
We'll make sure to add your information when we publish the podcast along the transcript at the
Great.
bottom. Yeah. Okay, wow. I just learned a lot today. I just want to say the three takeaways I got from this interview. Number one is regarding the tax savings coming from QSBS. Everybody should everybody who need it should take advantage of that. Turns out not many people know about it. Number two is if you are considering, of course, if you have a business, you should definitely consider planning for your exit because nobody lives forever. Either you transition it to another owner or to your children, to your family, to your employees, right? You have to really consider hiring an M&A advisor because if you're still listening right now, you can tell that it's not an easy process. It's complex, but it shouldn't be scary. Now, if your business is still thriving, you're just planning for the succession planning slowly, you're not ready to hire an M&A advisor, buy his book, you're going to learn a lot.
Yeah.
Or they can attend Visionaries Roundtable with 3 glasses of wine. We're going to look much better.
Exactly. So thank you very much, Jeff. It's a wonderful conversation. We learned a lot, or I learned a lot.
So
And
great to have you here.
yeah, it's a pleasure to talk to you, and I'm sure we'll have more conversations with you.
Yeah, well, thank you so much. I really enjoyed it. I really appreciate the time, and always a pleasure to see you both.
Thanks
Thank
a
you.
lot.
So, all right, there you have it. We'll see you again in our next episode. I'm your host, Jen Crow, and my co-host.
Mohan and thanks again.
Have a great day, everyone.